It's never too late. In this episode, we are going to address the question, if I'm already retired, is it too late to roll money out of an account like an IRA into an IUL? My name's Doug Andrew, and I've been a financial strategist and retirement planning specialist for more than 45 years. And this question has been asked me thousands of times when people come to me at age 60 or 70 or even age 80. Is it too late for me? Have I already made too many mistakes? You can't help me or correct what I've done wrong. Well, no, it's never too late. One of the messages that I've given in many of the educational videos and the books that I've written 11 so far, is that at retirement planning is far more important than what you maybe did for retirement planning. And it's never too late to correct. In fact, many times in my career, I felt like if I were a physician, let's say, I spent most of my time curing tax problems or problems with people's money where they had it in the market with volatility. Therefore, it could not create predictable income in retirement and so forth. So what you do at retirement sometimes is curing the dis-ease. See, when we say the word disease, it means you're not at ease, dis-ease. And a lot of people are not at ease financially. So many times people will ask, my friend who's an arborist, when's the best time to plant a tree? Well, the best time was 20 years ago, okay? So what's the next best time to plant a tree? Right now, sooner than later. So it's best to get started sooner than later, and I'm going to share with you now some of the critical elements that it doesn't matter if you are 60, 70, 80 years old, especially as it relates to an IUL. You're on this video because you were probably searching about, is it too late to get an IUL? That's an indexed universal life insurance contract, which is my favorite vehicle. I call it the laser fund for tax-free retirement planning. So let's go through some of the reasons why it's not too late. So it's never too late to convert to a tax-free strategy at retirement. Because I can prove to you mathematically, if you convert to tax-free, predictable income streams, it's far better than leaving your money in a tax-deferred IRA or 401k, taking required minimum distributions, which simply delays the inevitable and compounds the tax problem. You'll pay more in tax at the end of the day when you add it all up, and get the taxes over and done with sooner than later. This is what I call a strategic rollout. Now, an IUL, Indexed Universal Life Insurance Contract, is the only vehicle in the Internal Revenue Code that allows you to accumulate your money totally tax-free, and then it allows you to access your money tax-free. But a lot of people say, well, a Roth does that. Well, a Roth has a lot of strings attached. I like an indexed universal life insurance contract structured properly, which I call the laser fund, because it has the two benefits of a Roth, but four additional benefits that Roths don't have. And if you subscribe to this channel, be sure and search for the YouTube video that explains that difference of the laser fund versus a Roth. What I want you to be aware of is that when people would come to me at age 65, 70, 75, many times they would think, oh, golly, I've done everything wrong. It's too late for me, right? And I go, no. And then they were blown away that they could get incredible rates of return of 7, 8, 9, 10% tax-free at their age because they didn't understand, like many financial advisors don't understand, the cost of the insurance goes down as you get older, or it is the same whether you're a 22-year-old athletic marathon running female or a 68-year-old geezer like I am right now, or an 83-year-old friend of our family who I'll tell you a story about next. So as I alluded, the beautiful thing about indexed universal life is that under 3 sections of the Internal Revenue Code, you're able to set aside money and it accumulates tax-free, not just tax-deferred. That's under Section 72E of the Internal Revenue Code, and it's been around for over 100 years. Now, Section 7702 gives you provisions where you can access your money the smart way and have tax-free income for life. And so that's very powerful. If you have $1 million nest egg and you're averaging, like I have the last 25 years, 10.07%, you can have $100,000 a year of tax-free cash flow. You'd have to be pulling out $150,000 out of an IRA or 401k, pay tax of 1/3 for most Americans to net the same $100,000. And that $1 million nest egg, if it was earning 10%, would still be gone, drained dry in less than 11 years. But under Section 101A of the Internal Revenue Code, anything that you leave behind when you pass away blossoms in value, increases to a tax-free death benefit to your spouse, your non-spousal heirs, your children, grandchildren, a church, a charity, the Boy Scouts, the Red Cross, whoever you want to leave it to. So let me tell you this story. We had a 79-year-old friend of the family, but he had 3 strikes against him, okay? And so he had the life expectancy of an 83-year-old, even though he was 79, because he had 3 blocked arteries. Now, he had cleared him up with angioplasty. He had a prostate cancer episode, but he got through that, and his PSA levels were normal at age 79. And he also had adult onset diabetes, but he was controlling it pretty good with diet and exercise. Even though he had 6 sisters predecease him at earlier ages and 3 brothers predecease him at earlier ages, he had a little bit better lifestyle than a lot of his siblings. So because of these 3 sections of the Internal Revenue Code and also 3 tax citations, TEFRA, DEFRA, and TAMRA. TEFRA stands for the Tax Equity Fiscal Responsibility Act of 1982. DEFRA is the Deficit Reduction Act of 1984. When they created what is called the TEFRA-DEFRA corridor, the IRS gave parity, meaning it doesn't matter if you're 20 years old or you're 68 years old or like this, quote, 83-year-old gentleman. The cost of the insurance is the same for all of us because the amount of insurance required to have your money grow tax-free goes down as you get older and the more unhealthy you are. In fact, if he could not have qualified, we could have put it on his wife because it's the owner of the insurance contract that gets all the tax-free accumulation and growth. If you can qualify, it's good to have it on you because it doesn't matter how old you are, the cost of the insurance is called squeezing down the death benefit. And so if the rate of return in a given year is 11%, you net 10%. The cost of the insurance only drains out one of those percentage points, whether you're 20 or whether you're 60 or whether you're 80 years old. You wouldn't believe how many financial advisors and insurance agents do not understand that concept. Have you ever seen an insurance policy that gets cheaper as you get older? Well, then you have not seen one structured the way I'm going to share now. So with an indexed universal life insurance policy, not only are you allowed to squeeze down the death benefit the older you are and the more unhealthy you are, so that you have parity, but as you put money in that insurance contract, I compare it to a bucket. If the minimum required death benefit for a 60-year-old is $1,250,000 of life insurance for every $500,000 you want to put in there. Now, you can buy way more life insurance than $1,250,000 for $500,000. That's not the objective when you're using it for tax-free income. You want to have the least amount of insurance the IRS will let you get away with and put in the most money. So for a 60-year-old, it's $1,250,000 or thereabouts. If I were 20 years old, I mean, that would be $5 or $6 million, but that $6 million of life insurance at age 20 doesn't cost near what $1,250,000, okay, would buy later on. It allows you to squeeze down the death benefit. So maybe the 80-year-old would only have $700,000 of insurance to accommodate $500,000. Well, then the insurance company's only at risk for the remaining $200,000 because $500,000 of it is your money. It comes back tax-free if you die. Well, as the $500,000 grows, at 7, 8, 9, 10%, pretty soon the cash inside the insurance contract equals or exceeds the death benefit, And Teffer and Deffer just says the death benefit must stay ahead of it by 5 percentage points. So it basically means this. If I have an insurance policy that I've owned for 30 years, and if I earned 11% this year, I would probably net 10.9, 10.95 because the cost of the insurance is so small now, because the amount of insurance I'm paying for is so small, because the majority of it now is my own money. So if this intrigues you and you want answers to other questions like this, I would encourage that you read the book, The Laser Fund. It's my 11th book, favorite book so far, and it's actually 2 books in one. It's 300 pages, but 200 pages are comprised of 14 chapters with charts and graphs and all kinds of explanations. If you're more a right brain learner, you flip the book over, you read this direction, 12 chapters, containing about 62 actual client stories and examples. If you want to use your whole brain, you read both books, okay? But if you go to laserfund.com, that's laserfund.com, and pay $5.95 shipping and handling, I will pay for the book and send it out to you free.